So if I may quote Manjar here, he would always say that you should be ready, you should be prepared. So is that a good strategy for any long-term investor, that just wait for that loose ball and hit it out, identify a good business, but wait for that panic in the market so that you get your price?
That's his strategy, and it worked for him. And that doesn't take away the elegance or the intelligence behind the strategy of being almost fully invested in India. India is a growing market. India market cap has grown from less than $1 trillion 10 years ago to more than $5 trillion now, primarily because of the growth in India's GDP and also because new companies have come to market. So there is this very large pond in which we are fishing, and that pond is grown to now more than a $5 trillion, USD market cap pond, and it's going to keep growing as India grows. So in that sense, I don't see that as a problem at all. The key is to find out just a handful of companies. As you're going to have thousands and thousands of companies which are available for investing. In the job of the investor is not to select but to reject. It's primarily the problem from a mathematical point of view is to reduce from 5,000 odd plus companies to a portfolio of maybe a 10 stock portfolio, or a 20 stock portfolio, or even a 100 stock portfolio. So even if you were to, have a very widely diversified 100 stock portfolio, you still have to reject a few thousands of companies. So you need to have rules to quickly say no to what just doesn't make sense. And I think figuring out what those rules are is very important.